For decades, the golden rule of investing has been simple. Buy the S&P 500, set it, and forget it. It was the ultimate diversified safe haven. But if you look under the hood right now, that safety net is showing some serious stress fractures. This chart shows the S&P 500's shift. Just 10 companies now represent 40% of the index. Zooming into the biggest slice of that block, the math gets more skewed. For every dollar invested into this broad fund, 8 cents goes to one single stock. That outlier eating up all that capital is NVIDIA. This happens because the S&P 500 is market cap weighted. It's a simple rule. The more valuable a company becomes, the bigger slice of the fund it automatically takes up. As a few tech giants surge in value, they swallow the index whole. You aren't buying a small, protective piece of 500 different companies anymore. Instead of owning a balanced slice of the U.S. economy, passive investors are now making a concentrated bet on the technology sector. This heavy tech concentration is delivering market-matching returns today, but it reduces the safety in numbers that made index investing the default choice in the first place. The companies dominating the top of the index all share one specific trait. They are aggressively spending billions on AI infrastructure. To justify their current valuations, these companies need massive future revenues. OpenAI's Sam Altman intends to commit $1.4 trillion to build out AI infrastructure, while his company currently makes roughly $13 to $20 billion in yearly revenue. That gap is largely bridged by debt. This chart maps out how debt fuels a self-reinforcing stock market loop. These tech companies pump up their valuations. Higher valuations attract more passive index fund dollars from everyday investors. That flood of money pushes stock prices even higher, and the cycle repeats. The flaw here is that these massive valuations are not based on the cash these companies are earning today. They are priced entirely on the expectation of what investors hope they will earn years from now. If the AI hype cools or this debt-heavy bubble bursts, the math works in reverse. Because the index is so concentrated, it is now exposed to the same volatility as a single sector fund. This matrix compares 3 popular ways to handle this risk. The first instinct is often to switch from the standard cap-weighted S&P 500 to an equal-weighted version, where every company is strictly capped at a 2% share. But as the red warning highlights, equal weighting has a hidden cost. It uses a negative momentum approach. Whenever a stock starts to win and grow beyond 2%, the fund is forced to sell it and buy the losing companies to keep the balance. All that constant trading eats into your returns through high fees. The mathematically sound alternative is highlighted here in green, moving your capital overseas into a global index fund. A single global fund gives you instant exposure to nearly 4,000 companies spread across 45 countries. If one nation's economy falters, the fund automatically rebalances to capture the growth of whichever country is outperforming. When you only invest in the American index, you are completely excluding massive global manufacturing leaders like Toyota, missing out on real, tangible hardware growth. You also miss out on major international technology powerhouses like Samsung. They are excluded purely because of where their corporate headquarters happen to be located. Shifting to a global fund provides exposure to growth wherever it happens, while insulating the portfolio from a crash localized to the U.S. tech sector. Because the U.S. has dominated the markets for the last 14 years, betting your money anywhere else feels foolish right now. But look at this historical chart showing different countries' shares of the global stock market. The total market size stays the same, but the layers change. Back in 1900, the United Kingdom held a massive 24% slice of the global economy. At that time, London was the undisputed financial capital of the world. If you were investing then, assuming the UK would remain dominant forever felt like the only logical choice. Fast forward to the late 1980s and early 90s, and the chart shifts again. The layer for Japan expands to dominate global market share as their electronics and auto sectors surged. Economic leadership rotates. Assuming the U.S. will permanently hold the top spot creates a massive geographic blind spot in your portfolio, exposing you to exactly the kind of risk long-term investing is supposed to avoid. True portfolio stability requires looking beyond stocks entirely. This chart plots investment assets based on their liquidity and their growth potential during a crisis. In the bottom left, we have gold. It offers low growth and low liquidity, but it acts as a hard insurance policy against a devaluing currency or a systemic tech crash. This is a proven institutional strategy. Under new Basel III regulations, physical gold is now classified as a Tier 1 asset, meaning central banks can treat it the same as cash on their balance sheets. They are accumulating it heavily right now for stability. The final tool for your portfolio is highly liquid cash reserves. Even Warren Buffett, the most successful value investor alive, is currently holding hundreds of billions in cash rather than forcing it into an overvalued market. Holding cash is a difficult choice because it produces zero yield and actively loses purchasing power to inflation every single year. Cash provides the liquidity needed to avoid selling at a loss and the ammunition to buy assets when the market eventually resets. With these tools identified, this flowchart maps two distinct allocation strategies. If you are a beginner looking for safety without managing daily trades, it maps a simple route. Hold your current S&P 500 assets, but redirect new money into a global index fund. This approach lets you gradually build global stability without triggering a tax bill. But if you're an optimizer actively protecting against the AI bubble, the flowchart branches. You actively reallocate into a core global position, a gold hedge, and an elevated cash pile. The trade-off here is maintenance. It requires active discipline to hold cash that isn't growing, but it constructs a structural fortress that will hold firm even if the tech sector collapses. Ultimately, there is no perfect universal portfolio. The only way to sleep soundly during market volatility is to honestly match your allocation to your personal risk tolerance. Right now, the crowd believes the S&P 500 will just keep climbing without consequences, but lasting wealth is preserved by recognizing structural risks early rather than following the herd into a concentrated, debt-fueled bet. By deliberately balancing your portfolio across global equities, hard assets, and cash, you stop trying to guess what the market will do tomorrow and start preparing to thrive in whatever reality comes next.